Welcome, everyone. My name is Emily Curran with Wealth Shield Financial. We are going to get started in just a minute, but before we do, I know you're all probably tuning in from either work or home. You're on your own device and there can be a lot of distractions. So I just want to remind you to eliminate all distractions before we start. We are not going to take up too much of your time today. It's going to be about 45 minutes long if you don't have too many questions. But for those next 45 minutes, I just ask that you please leave your phones face down, try to eliminate any distractions around you. We don't want you to miss anything in the presentation. We hope that will provide some value for you, and we don't want you to miss anything important that you would need for your retirement. If you do have questions throughout the presentation, there is a Q&A box on the right side of your screen. You can type those questions in there, and we are going to try and answer everything through the content in our presentation. If there's a question you put in there that we didn't get to today, you can schedule a 15-minute strategy call. A link will pop up on the bottom of your screen where you can schedule that, and we'll be able to answer any personal questions during that call. So I'm going to kick it off today introducing our managing partner, Matthew Lang. He has been in the business for about 20 years now. He is really passionate about what he does. He's worked closely over the past 20 years with retirees and pre-retirees like yourselves, and he's really passionate about helping families. He is also a husband to his wife, Ashley, and a father to his three wonderful kids, Preston, Addison, and Dylan. And he's going to start us off today with a story.
Emily, thank you for the kind words. So I'm going to start today with a quick story. So about 10 years ago, we had a client, Patricia, come see us. She was an RN and a single mom with two children. And she approached us asking questions about retirement and how she should go about preparing herself. She was about 60-ish years old at the time and was kind of thinking about retiring within, let's say, the next 5 or so years. So we mapped out an income distribution plan so that she would be able to understand how to utilize her savings, her investments, let's say her 401k from work or 403b, and if she had a pension. In this case, she did not have a pension, but how to maximize those assets for income in retirement. We also looked at legacy planning. How could we do that, and was that of interest to her? Did she want to leave money, let's say, to her children or grandchildren? We also talked about long-term care, and if that was a serious concern to her, and did she need long-term care, and how would we pay for long-term care? So she sat with us and went through our process, and over the course of a few meetings, we developed this plan and implemented the plan. About 5 years later, unfortunately, we got the call that Patricia was diagnosed with lung and throat cancer, and we had another meeting, and we needed to kind of review this plan and look at the strategies that we had put in for her. And these strategies that we used were going to work whether she lived, whether she passed away, or whether she needed some long-term care along the way as she fought this battle with cancer. So unfortunately, Patricia did pass away, but was able to pay all of her bills. She was able to pay for the care needed during the process of fighting cancer. That was, I guess, about an 18-month battle. And she was also able to maximize what she had saved and pass as much money as possible to her kids and grandkids. So the plan that we put in place utilizing these strategies would allow for success under all conditions, whether she had lived, whether she had had a longer struggle with cancer and lived, or whether she had passed away, and how she would feel about maximizing what would be left to her heirs. I'm here to tell you that that person, Patricia, is my mom, and I'm extremely passionate about what we do. It hits home very hard for me, and I will work just as hard for you as I have for my own mother. So Wealth Shield Financial is who we are. We're based in Summit, New Jersey. We have been around for about 20 years. Our core market is pre-retirees and retirees like yourself. We're basically here to educate through seminars and webinars to better understand how to take the next step from your working career into your retirement career. Emily was kind enough to introduce me. I'll just briefly go through. I've been in the business for about 20 years now. I got into this business through my father, who was also an advisor, for the good part of 40 years. So I kind of didn't really have a choice. I was kind of forced to take the next step and join this industry. And I'm very, very grateful that he encouraged me to do so. My focus point has been on pre-retirees and retirees. The next person up would be Chris Budd. Chris Budd is the Director of Retirement Strategies. He's our expert on Social Security. He's also an expert on income distribution strategies. And Chris works with me to develop your plan when you come see us. Emily Curran is the Director of Marketing and Client Relations. She's the newest member to the Wealth Shield team. Her father is a published author and expert on college planning, and felt that it would be a good fit for her to join our team and to learn more about the business and come into the business somewhat like I did through family. Our value add is a Social Security analysis and roadmap for success in retirement. But today we're offering a 15-minute strategy call. As Emily mentioned, there should be a Calendly link popping up at the bottom of the screen so that you can schedule with us right now. I'm going to turn it over to Chris Budd, and he's going to walk you through Social Security.
Matt, thanks so much for the introduction and the kind words. So today, what I'm going to do is talk about a few key topics and a few different strategies on how to maximize Social Security and for you to better understand how Social Security can work for you. The first point we always like to make is that for an average couple in the United States, Social Security will be roughly between $600,000 and $800,000 of cumulative benefits in retirement. That's the equivalent to a very significant 401k, and it's one of the main reasons you need to make sure you get your benefit election correct. So the first point in understanding Social Security is getting to know how you qualify for Social Security. To qualify for Social Security, you need to have 40 credits. To earn 1 credit, you must work for a quarter, and in 2021, the limit for the earnings for that 1 quarter is $1,470, meaning you have to earn that much to earn the credit. In 1 year, you can earn a maximum of 4 quarters, where you must earn $5,880, and you have to work for a period of 10 years. So you have to have 10 years, 4 credits a year to get the 40 credits. Your final Social Security amount or primary insurance amount will be the average of your 35 highest earning years. What that means is if you work for 30 years, your average will include 5 zeros. On the contrary, if you work for more than 35, the lower years will be kicked out and you'll take the highest average, or the average of the 35 highest. So another key concept beside qualifying for Social Security is this idea of full retirement age. Full retirement age is the age that the Social Security Administration deems that you can collect 100% of your full benefit amount. Your full benefit amount, or your primary insurance amount, is the big number in the top right corner of the statement you get from Social Security every year. In 1935, when Social Security was signed into law, everybody's full retirement age was age 65. However, in 1983, Congress changed the law for Social Security full retirement age to be based on your year of birth. As you can see in the chart to the right, if you're born between 1943 and 1954, your full retirement age is age 66. If you were born in 1960 or after, your full retirement age is age 67. Those people who were born between 1943 and 1954, I'll use you as an example on the next slide. So, some people may know, some people may not, that Social Security, if you defer past your full retirement age, grows at a guaranteed 8% per year. On the contrary, if you collect your Social Security before your full retirement age, you are penalized for starting early. Let's look at an example at the chart below. If your full retirement age is age 66, at age 70, if you waited to collect your benefit, you would receive 132% of that full retirement age benefit amount. On the other side, if you collect early and you can start Social Security as early as age 62, you'll receive only 75% of your full retirement age benefit. One key you can see here to maximize Social Security is to defer. However, that's not always the best solution for you and your family. Another thing people are concerned about with Social Security is taxes. And yes, folks, even though you paid into Social Security, it is taxed when it's coming out. Up to 85% of your Social Security can be taxed. It doesn't mean 85% of your benefit goes back to taxes. It just means up to 85% of your Social Security benefit can be included in your taxable income. The thresholds for this are fairly low. As you'll see here, if you're single head of household and your income is greater than $34,000 in a year, up to 85% of your Social Security is taxable. If you're married filing jointly, you don't get much more wiggle room. If your income is $44,000 a year or greater, up to 85% of that benefit is also taxable. As we know, many things vary from state to state, and only 13 states actually tax your Social Security benefit. So that's something in retirement you want to be extremely aware of, and something we always keep in mind when discussing a retirement move with our clients. Now we're going to look at 4 different categories of different strategies to how to claim your Social Security benefit. The first strategy or benefit you can use is something called a spousal benefit. If you are married, you are entitled to 100% of your own Social Security earnings record or 50% of your spouse's full retirement age benefit amount. Let's look at an example on how Mark and Tina can use the spousal benefit. As you'll see here on the left, Mark and Tina are both age 66, and let's assume that's their full retirement age. Mark's benefit is $2,400 per month, and Tina's benefit is $1,000 per month, meaning their couple total monthly benefit is $3,400 per month. If all they did was go to Social Security at full retirement age or go online and file for their benefits, they would get those checks every month, plus maybe some cost of living adjustments in the future. However, if Mark and Tina utilize the spousal benefit to maximize their benefit, they could see a large increase in retirement. Let's see what that looks like. Tina would still go down to Social Security and collect her full retirement age benefit at age 66 for $1,000 a month. Mark would defer his benefit out to maximize it at age 70, and at that time, his benefit would be $3,136 per month. Tina can then refile for a spousal benefit of $1,200 per month. Remember, 50% of Mark's full retirement age benefit. A key concept here is you always have to be aware of what type of benefits are available to you. Social Security is not going to call Tina and say, we noticed Mark filed his benefit and we owe you $200 a month for his spousal benefit. You have to know what you're entitled to, and you have to be proactive about claiming it. That is certainly one value that we add to our clients. Another Social Security benefit option is a divorced spouse benefit. To qualify for this benefit, you had to have been married for 10 years or more and currently divorced for more than 2 years. Again, you also have to be not married at this time or at the time you file. Very similar to the spousal benefit, the divorced spouse is entitled to 50% of their ex-spouse's full retirement age benefit or 100% of their own full retirement age benefit. You can begin collecting this benefit as early as age 62. Again, you will be penalized for starting early. One question we get a lot about the divorced spouse benefit is you don't have to get approval from your ex-spouse to qualify. It has no impact on your ex-spouse. All that has to happen is your ex-spouse has to be eligible to collect Social Security, meaning they're age 62 or greater and they've qualified for those 40 credits. Another key maximization point is a survivor benefit. Unfortunately for widow and widowers, or fortunately for widow and widowers, there is some Social Security benefit for them. If your spouse is deceased, you are entitled to the greater of 100% of your own full retirement age benefit amount or 100% of your deceased spouse's benefit amount. You can also start this benefit as early as age 60, but again, you'll be penalized for starting early, and the full retirement age chart is slightly different, but we don't include it in the presentation because it does lead to some confusion. The last category of Social Security benefits is for people who are single and have never been married. The key for this is to defer as long as possible. However, like I mentioned before, maximization is not always the best strategy for you. The key to getting the most out of your Social Security is what we call optimization. And that's not knowing just Social Security as a number, but it's knowing how Social Security can be used to make your retirement as successful as possible. If you're going to retire at age 60 and your maximization for Social Security isn't till age 70, how can you survive from 60 to 70 without that salary that you're used to? And that's really how we help our clients. Just to answer some frequently asked questions we get, the first one is, can I collect Social Security before my full retirement age? The answer to that is yes, but again, you'll be penalized for starting early. Another issue with collecting before your full retirement age is something called the retirement earnings test. If you collect Social Security benefits before your full retirement age, your benefits can be reduced based on how much you earn. The threshold for this is fairly low, somewhere around $44,000 for 2021. When you earn up and above that amount and you're collecting your Social Security before your full retirement age, your benefits are reduced. Social Security doesn't just take those away from you. They do give them back to you once you reach your full retirement age, but that is something you need to be aware of if you're collecting Social Security early. What impact does Medicare have on my Social Security? Medicare premiums are deducted from your monthly Social Security amount. The base premiums are roughly $147 a month. However, there is something in Medicare known as income-related monthly adjustment amount. And what that means is at the end of the tax year, you can actually get a letter from the Social Security Administration saying you owe additional Medicare premiums. This comes as a monthly increased cost to your Medicare base premium, and it's based on how much you earn. The Medicare adjustment amounts start at income levels of around $85,000 for individuals and $170,000 a year for couples. Meaning, if you're a higher income earner or have lofty retirement goals, you'll need to definitely be aware of the increased Medicare costs due to IRMAA. Another question we get is, how can I maximize Social Security to my spouse when I pass away? And this question brings up a massive point, that Social Security, if you are married or have dependents, is not only a one-life option, it's a multi-life option. You need to be aware of the consequences that a premature death or a misfiling or misapplication for Social Security can have on your family. If both spouses elect Social Security benefits at age 62 and nobody maximizes their benefit, you could be losing out on a lot of money if there's a premature death. Please take note that when one spouse passes away, the lower of the two Social Securities drop off, meaning if you have two spouses collecting $1,000 a month, when one passes away, Social Security doesn't continue at $2,000 a month. It'll drop down to $1,000 a month. So maximizing Social Security to your spouse when you pass away could be a little bit of a tricky situation. And I would definitely ask that you book that 15-minute strategy call to discuss those options with us. And the last question is, when is the best time for me to start taking my Social Security? It's definitely different for everyone, depending on your individual situation and what your goals are. Another factor in taking Social Security benefits that not a lot of people consider is how healthy you are and what your life expectancy might be. If you have any questions related to these FAQs, I would highly encourage you use the Calendly link below to book your 15-minute strategy call with us, and we can get you started on that Social Security analysis. The last point I'd like to make is Americans leave over $25 billion of unclaimed Social Security benefits on the table each year. By working with us and getting to know a little bit more about how Social Security can apply to you, we can make sure you're not included in those millions of people leaving those billions of dollars on the table each year. Again, please feel free to book your 15-minute strategy call with us. And what I'm going to do now is pass the baton back over to Managing Partner Matthew Lang, who's going to take us through some income distribution and risk management strategies.
Thank you, Chris, for doing such a good job explaining Social Security. So from here, I'm going to take this part of the presentation and talk a little bit about income distribution and risk management. And we think it's important because you can't really figure out your Social Security optimization without understanding the overall income distribution plan. We think there are two distinct phases in your financial life. There's the accumulation phase and the distribution phase. The accumulation phase is your working career, saving money, buying a house, earning your peak income, maybe funding retirement plans, brokerage accounts, kind of marching to the top of the hill. And then the distribution phase is where we get to the top of the mountain and we start to look down and we start to look at our retirement. And what is that going to look like? Well, we specifically focus in the distribution phase and how to create the most income as we come down the mountain and understand those risks and how to navigate them while providing the retirement that you have worked your entire life for. So how do we plan for retirement? We think there's 5 key risks that we need to be aware of and that we need to kind of address. So I'm going to touch on all 5 of these now, and then we're going to do a little bit of a deeper dive into each individual risk and how they may correlate to you. Longevity risk. Will I have enough money to live for the rest of my life? That's the number 1 risk. Second risk would be health risk. Am I protected against critical illness, critical injury, long-term care? And how do I plan for that? Mortality risk. Will my family be okay if there's a premature death of a spouse? And how are we accounting for that? What are our options? What's the strategy? Inflation. Inflation is pretty self-explanatory. I think most folks on today's webinar would understand that it's been around for a long time. It's a silent killer in retirement, and we will kind of work through how to fight inflation in the future. And the last one is market risk. Market risk, as in 2008 crash that made many folks go back to work. How are we balancing the amount of risk, the proper amount of risk and exposure to the market in our own retirement plan? So I'd like to take a minute and run a poll here. Which risk concerns you the most? All right, so let's do a little bit of a deeper dive into these 5 risks. So the first one being longevity risk, and is am I going to outlive my money? The number 1 question we get from our clients. So the way to look at this would be kind of taking a look at the graphic on the left-hand side. It's the past and the present, right? So in the past, your personal savings made up the smallest component of your retirement. The Social Security still held down the middle ground and provided a huge piece of your income. And pensions, which was the mainstay of your retirement income. You worked your 30 or 40 years for XYZ company, and they provided you with a pension benefit. And that really was what supplied you with the income to live out your retirement. That has shifted. Now, the personal savings component makes up the largest component of your retirement savings. And we have to utilize those monies, whether that was savings, brokerage, 401ks, 403bs. How do we take that money and create an income stream that you can live off of in retirement? Social Security still is the middle component, providing a strong piece of your income. And then the smallest part would be a pension. There are some folks in certain industries that still do get a pension. So I think you're going to see here why it's so important to maximize and optimize your Social Security along with your other income sources so that you can get a much more complete picture of your income benefit. Health risks. So if you look at the chart in the middle, the graph in the middle of the page, you can see that the cost of care has exploded over the last few decades, and it probably will continue to do so. We know that the total cost of care could reach $700,000 for a couple. That's the equivalency of a large 401k. So we need to be planning around health risks, whether that's long-term care, something more acute like a critical illness, which may be something like a heart attack, cancer, or stroke, because we don't necessarily have $700,000 today sitting on the sideline to use for that health risk. We also know that in some states, the cost of care for a semi-private room on a monthly basis for long-term care is approaching $11,000 a month. That's a huge number. And so what we would like to do is sit down with you and address that risk, take some time to figure out what the solutions are, because we also know, statistically speaking, 70% of baby boomers will need some care at some point in their retirement. Mortality risk. So how does a premature death of a spouse impact the surviving spouse's retirement? And that's a really important question to ask, because Chris explained so eloquently that Social Security, when one spouse passes away, you do not keep both incomes, you only keep one income. So if one goes away and it was $1,000 a month and they were premature death, they were fairly young, we could see 20 or 30 years more of income that's now being lost. How do we recoup that? Because that surviving spouse may need that money to make their income plan work. So maybe life insurance is a good solution to replace the lost income. It also works for, let's say, a family, a spouse, a couple that has an income gap, an age gap, let's say, of 10 years. And the one spouse is going to continue to work while the other one retires a little bit earlier. How do we recoup that lost income potential? And again, life insurance typically works very well there to kind of refill the bucket and allow that surviving spouse to create an income stream that is where you both would have wanted to be if you were both alive at that time. So what we're looking to do is eliminate the risk of losing income in retirement through a premature death. Inflation is the silent killer of retirement. It's been out there for years. It's not as bad now as it has been in the past, but it's really essentially the purchasing power in the future of your dollars. Can you afford to buy the goods, services, and things that you want in your retirement? And 20 years from now, is that going to work? So where you are today, buying the things that you want now, you may or may not be able to afford in the future if we don't get a plan around that issue. Market risk, I think everybody today on this particular webinar would understand market risk. 2008 was the last big correction we had outside of the pandemic, but 2008 really ruined a lot of people's retirements because the market crashed and most people didn't get out in time, and then they didn't get back in for 2009, where the market corrected quite substantially and would have lifted those 401k balances, let's say, and allowing that person to potentially retire still on time or closer to when they would have liked to. But it actually made a lot of people have to stay working for 2, 3, 5 years, longer than they expected, or some folks never even got the chance to retire and they had to take employment doing something they didn't want to. So we want to be the voice of reason there, to take a look at what you're doing and make sure it's in line with your risks, what you can afford to risk, and how much are we allocating towards the market. Can we create some certainty around income in retirement and eliminate market risk? And that's a discussion that we would like to have with you on our 15-minute call to kind of go through the strategies. We think that working with an advisor is critical. We think that we can help you protect yourself against some unknown risks or unknown things, such as fear. So the pandemic is coming to a close, but let's say a year ago, there was a lot of fear around COVID in general. What did it mean for the economy? What did it mean for your retirement, for your health, for your mortality? Things like that were swirling around. People were very upset, rightfully so. An advisor is there to kind of be the voice of reason so that we don't make knee-jerk reactions, make bad decisions, let's say, in the market, sell because we're panicking and costing ourselves X amount of dollars in retirement. Increased taxes is one that we hear a lot. Most of our clients are very concerned with the potential for increased taxes, and we need to project out what they could look like so that we're ahead of the curve and not behind and reactive to the curve. We want to kind of map out what the potential impact of those tax law changes could be on your retirement. And that's why working with advisor is so critical. We also want to understand the regulatory changes. In the beginning of 2020, there was two pretty substantial changes with the Secure Act and the CARES Act. What we would do for you there is kind of take those acts and explain them to you and how they're going to impact your retirement. We also want to work with you on your required minimum distribution. That's where Uncle Sam and the government says you have to take money from your qualified plans. That would be your 401ks, your IRAs, your 403bs. And we want to help you calculate how much is needed. And are we doing it the most tax efficient way possible? And then economic conditions, changing economic conditions, they're bound to happen. It could be from conflict. It could be from just about anything. But we want to be there for you to help you understand what the right moves are and if they are going to impact your retirement plan. If you fail to plan, you are planning to fail. We believe that to be true. I'm going to share with you a story about two of our clients, and they kind of didn't have a plan until they met us. So Joe and Donna came to us, and they were very worried about their retirement plan. They had been working, Donna had worked for a Fortune 500 company for, let's say, 30, 40 years. Joe had worked for the city for the same amount of time. They felt that they were diligent savers. They felt that they did everything in their power to save for retirement. They were joking around saying that they had brought a bagged lunch for 40 years, right? They took one vacation per year because they had a goal of retirement. They knew what their retirement should look like or wanted it to look like. And they were pretty much just putting money away. They had no written plan. They had no actual strategy. They just were savers. So they came and saw us. They went through our process. In our meetings, we went through the planning and we put up a plan for them. And we were looking at the income. And Donna started to cry. And I said, Donna, what's wrong? She said, I worked my whole life for that number. That's not acceptable. I can't live on that. And I said, Donna, that's your monthly number, not your annual number. And she quickly started to cry even more, turning to her husband and said, we're going to be fine. And I said, you are. And she said, that's more than our working income number. And I thought that was really impactful. They quickly retired from both of their jobs, and they started living the retirement that they wanted. They sold their house in New Jersey, they bought a place in Florida, and they bought a place in Cape Cod. And we check in with them on an annual basis to make sure that we're still doing the right thing for them and that everything is on track and there's been no major changes. But it allowed them to take that step and retire on their terms when they wanted to, because the things that they did worked out for them and it lined up on paper and it allowed them to go. And we would like to do the same for you. So Chris and Emily have both said that there's a Calendly link at the bottom of the screen. We encourage you to take advantage of that and book a 15-minute call with us so that we can start the process of discussing some strategies. Research has shown that 60% of people looking to retire think they could use a little improvement in their financial planning. We agree. We think that we could be a voice of reason, a second set of eyes, to kind of look at some of the things that you've already started and possibly make them better. Again, we encourage you to take advantage of the complimentary 15-minute phone call. We should work together. Connect with us. You can see our website there. You can connect with us on Facebook and Instagram, and we look forward to meeting with you soon. Thank you.